to how many stocks that you should own for safety and growth, most investors are following advice that's dangerously outdated for 2025. I want you guys to note that people have heard that old saying, don't put all your eggs in one basket, right? It makes sense. It really does. So you buy a few stocks, then you hear a horror story about someone who lost everything on one company. So you buy a few more. And before you know it, you've got a portfolio with like 30 or 40 or even 50 different companies. You feel safe. You feel diversified. But what if I told you that for most people, this is a trap that gives you the illusion of safety while quietly sabotaging your potential for real life changing growth? The question is, how many stocks should I own? Seems simple, but it's one of the most misunderstood questions in all of investing. The answer isn't just a number, it's about fundamental conflict every investor is facing, the battle between concentration and diversification. Own just one or two stocks and you're exposed to catastrophic risks. You are also going to experience extreme gratification when you're dealing with massive gains. A single bad earnings report or a new competitor could wipe you completely out. But on the other hand, owning too many stocks creates a different, sneakier problem. Leads to what the legendary fund manager Peter Lynch calls de-worsification, a portfolio so watered down that it's doomed to mediocrity, almost guaranteed to never beat the market and nearly impossible for a regular person to manage well. So, in tonight's show, we're going to break down the old advice that's been pushed for decades. We'll walk through the exact framework professional investors use to solve their problems, a strategy that's getting you almost all the safety diversification without dismantling your returns. It's about a magic number, but a smarter way to structure your portfolio in 2025 and beyond. So we're not really focused on that magic number. We're focused on a better structure. By the end of tonight's show, you'll know how to build a portfolio that is both safe and powerful, and you'll understand why the number of stocks you own is far less important than how you own them. Now, you've been told to own 30 or 40 or even 50 stocks to be diversified. And for most people in 2025, that's advice that can seriously damage your returns. The truth, you can get nearly all the safety benefits of diversification with a much smaller, more manageable number of stocks. The key isn't some magic number, but a specific strategy that balances risk and growth. So we're going to look at the studies. We're going to hear from the greatest investors who've ever lived, people like Warren Buffett, Benjamin Graham, and Peter Lynch, and we'll put together a clear, actionable plan that you can start using today. So let's start with one core conflict. On one side, you have the very real fear of concentration. We all know the horror stories. The Enron employees who had their entire life savings tied up in a company stock only to watch it vanish. The tech fan who went all in on a can't miss startup during the dot com bubble and got wiped out. That fear is what pushes most investors towards owning a lot of different stocks. It's a logical impulse. If one stock blows up and it's only 2% of your portfolio, the damage is contained. If it's 50% of your portfolio, it's a disaster. This fear creates a powerful pull towards diversification. Wall Street loves this. Financial advisors and the media constantly preach the gospel of diversification. We've even talked about some areas of diversification on this platform over the years. And on the surface, it makes total sense. The more stocks that you own, the smoother the ride. The heart stopping peaks and valleys of a single stock getting flattened into gentle rolling hills is soothing for you. It sounds great. It sounds responsible. But here's the part that they don't tell you about. On the other side of the battlefield is the silent killer of returns, over diversification. While owning 50 stocks might feel safe, it creates a whole new set of problems. For the average individuals, investors, someone with a job, a family, a life outside of reading financial reports, owning a huge number of stocks isn't just less than optimal, it's a recipe for failure. I'm going to tell you, all of the stocks that we're talking, well, not all of them, the majority of the stocks that we're talking about today, you're going to see them going across the bottom of the screen in the ticker thing. It's got the name and the ticker of all the stocks. But if you notice, there's about 40 or 50 stocks going across the bottom of the screen. It took me 30 minutes to update that list. It's a manual updated list. This is not automatic, real time, real life stocks. But I did it right before the show. One of the reasons why the show started late. So that is the closest to the stock values today, Tuesday, right? Where, like we talked about yesterday, when we were supposed to buy DHT, but because we sold ABR right before the weekend, we couldn't trade on Saturday and Sunday. So we could not buy DHT on Sunday so that we would have had it for Monday. So we had to skip DHT on Monday and buy RM stock. And we were thinking about, oh, we could have bought um, CHRD, but if we would have bought CHRD has a $1.30 dip uh, on the ex-dividend date. We would have bought Energizer. Energizer would have gave us more return for the value, but Energizer on Monday lost 50 cents a share. So when we bought into RM stock instead of buying into Energizer, we actually did good because when we sold RM stock today, we sold at a gain instead of selling at a loss. Um, Cord stock, we're looking at, I got to look at Cord stock, but I think Cord stock just went down a little bit because Cord stock CHRD, uh, oh, it's going through the list right now. CHRD is halfway through the list, and because right now it's heading towards the part where we start talking about the non dividend paying stocks. Right after it passes all the oil companies, it starts going into the hotels, then Johnson and Johnson, then Oracle is a growth stock. That's the one that's going to be buying TikTok. ABGO and Sterling are also growth stocks. FCB is a growth stock. Jet is a cash stock. CCL is a cash stock because that's the Carnival Cruise Line. Tesla is a growth stock. Uber is a growth stock. This is what we're looking at now. When we get to the oh, NIO is a growth stock in China. Coinbase, you can invest in the Coinbase platform instead of having cryptocurrency. We had MSTR, which is a growth stock. Cloud is a growth stock, and then the other one there, BBAI, is a very cheap tech based growth stock. But when we looked at the last time I seen Cord, it was like 101, 101 and some change. And I think right now it's at about 100 even. And then tomorrow it should go down a dollar and some change, $1.30. And if it goes down that $1.30, then that means that you would lose that $1.30 on sale, gain the $1.30. Oh, it's up to $102. So if it drops $1.30, then it'll be right around the $101 that it was when we were looking at it the other day. So it might actually break even, and then you still get that $1.30, which also means that instead of us getting what we are getting from um, RM stock, there's a possibility that Cord stock probably could have gave us an extra $10, $10 or $15 for the dollar for dollar exact difference. Now, I don't feel bad about the fact that I got the RM stock versus the Cord stock because I did not want to risk losing that $1.04 because when we were following the Cord stock wasn't doing that well over the past few days. And this is the first month that we're grabbing these stocks. As you monitor these stocks month over month, you're starting to see the patterns of fluctuations, and then you start seeing when it's a good time to buy versus when it's a good time to sell versus when it's a good time to hedge. And that gives you the ability when those stocks go up, you hedge them. When the stocks go back down, you buy back in. And that gives you more before the ex dividend date so that when the ex dividend date does occur, you have a larger return. But just updating the list took me a half hour. So checking the list would have been equally difficult for someone who was trying to, especially if you're new at this, someone who was trying to make this work for themselves, because you would have to go into the stock, look at the rotation over the past month, and then decide to buy or sell, or look at the current stock price, see if it's up, and see if you're going to sell it now or if you're going to wait a couple days and sell it later. Because if you remember, last month or a couple of weeks ago, certain stocks that we're not investing in now were going up significantly because Cord stock went from like $99 to like $105. And if you would have bought it on the way up, you would have sold it when it went down to $100, and then you would have bought back in. See what I'm saying? And that $4 a share difference between when you bought it at 99, when you sold it at 105, and when you bought it back in again at 101 or 100, you would have been looking at that $5 share difference off of 100 shares. That's $500 profit. And that's not the ex dividend. That's just the buying and selling. So being able to track these, we were focused on a dividend rotation strategy. And by focusing on a dividend rotation strategy, all we cared about is walking away from the stock with the same amount or more money than what we bought in so that we could benefit from the dividends, which is giving us 3 times more dividends than collecting monthly. But now we're talking about today, we're talking about working with a whole platform that you can just rebalance and benefit from all of the ex dividends. And maybe next month I'll give you guys, because next month is like 2 weeks from now. So maybe next month I might actually give you guys a sample of what this portfolio might look like if you were rebalancing this platform, because we will be talking about how to rebalance a platform such as this. But I want you to think about real quick how investing is pitched today to us. It's practically an entertainment industry. The constant tickers on TV, just like the ones that we've got going across the bottom of the screen, the dopamine hit of a stock alert on your phone, the endless hot stock tips on social media, the ones that pop up in your emails and stuff. It all encourages you to do something. Buy a little of this, a little of that, sell something. Your buddy at work mentions a biotech stock, so you buy a few shares over there. You read an article about the future of AI, so you buy a couple tech stocks over there. Soon, your portfolio looks less like a well tended garden and more like an overgrown jungle. You own dozens of companies that you probably can't even name, let alone explain why you bought them. This creates 2 massive problems. First, you have no idea what you actually own. Your portfolio is a black box. It goes up, it goes down, and you don't really know why. You have given up your role as an investor, someone who strategically puts capital into businesses that they understand. And you've become a collector of tickers. You diversified away your risk, but you also diversified away your knowledge and your focus. Second, you are now guaranteed to get average results at best because you have to understand that your portfolio's return rate is going to be the average between your highest paying stocks and your lowest paying stocks. And the more stocks that you have that are lower than 8%, the lower your average is. The more stocks that you have that are volatile stocks that are operating at 18%, the higher your percentage is. And then if you're like me and you're dancing on a dividend rotation strategy, in addition to that, the ex dividends that you're rotating out are also going to play a key role in the resolution of whatever else you diversify on your portfolio. Second, you are now guaranteed to get results that are probably the same, if not less, than the S&P 500. Because once you own 40 or 50 stocks, you put for portfolio, your portfolio starts to look exactly like a market index fund. And that's why things like the S&P 500 has a very low ex dividend rate, and it has a pretty decent but close to 4% APR attached to it. The problem is you've created a messy, inefficient, and expensive version of an index fund. You're dealing with the headache of tracking dozens of positions, and you're still not as truly diversified as an index fund that holds 500 stocks. You've accepted market averages, returns, while taking on workloads of an active stock picker. It's the worst of both worlds. This is the diversification dilemma. So you're stuck between the rock of single stock risks and the hard place of mediocre, diversified returns. Most investors, not knowing what else to do, just default to owning way too many stocks, thinking it's the safe path. They are mistaken. Let's dig a little deeper into why the conventional wisdom of just buying 30 or 50 stocks is so flawed, especially for you, the individual investor. First, let's talk about the actual math of diversification. The core idea is that combining assets that don't move in a perfect sync reduces the overall choppiness of your portfolio. The foundational research on this goes all the way back to a 1968 paper by John Evans and Stephen Archer. They studied how portfolio risks went down as you added more stocks. And what they found was revolutionary. The benefits of diversification happened very, very quickly. Adding a second stock to a portfolio with just one cuts risks dramatically. Going from 5 to 10 gives you another big drop in risks. But as you keep adding more benefits, the benefits shrink faster. Picture a graph of a portfolio risk. As you add a stock, the risk line plummets. But somewhere around 20 to 50 stocks, that line starts to flatten out. Going from 20 to 30 stocks provides a tiny, almost unnoticeable reduction in risk. And going from 30 to 50 or 100 barely moves the needle. Why? Because at that point, you've gotten rid of most of the unsystemic risk, the risk specific to one company, like a factory fire or a bad CEO. What's left is the systemic risk or market risk. That's the risk of the entire market going down because of a recession or a global event. So no matter how many stocks you own, you can never get rid of market risk. A portfolio of 500 stocks will still fall during a market crash. The research itself shows that the risk reduction benefits become trivial after about 20 stocks. So, why does the advice to own 30 or 40 stocks or more persists because it serves the interests of a financial industry that often profits from complexity, but it doesn't necessarily serve you. So now let's get practical. Let's say you decide to be a responsible investor and own like 30 individual stocks. Do you have any idea how much work that actually is? As I told you, it took me almost a half hour just to update the tickers, which meant that I had to go look at each stock and update the value of the stock and the percentage change since yesterday. To properly follow just one company, you need to read the annual reports, which is the 10K, which is often over 100 pages of dense financial language. Read the quarterly reports and the 10Qs 4 times a year to see if your investment thesis is still on track. Listen to the earnings calls every quarter to hear management answer tough questions from Wall Street analysts, right? Follow the industry to keep an eye on competitors and new technologies. Understand the valuation to know if the stock is cheap or expensive right now. That's just one stock. Now multiply that by 30 companies. You'd have to get through over 150 financial reports, listen to 120 earnings calls every single year. It is, without exaggeration, a full time job. Are you going to do that? Of course not. Here on This and That, where we talk about this, that, and everything in between, even we're not going to do that. No one with a normal life can do that. So, what really happens? You cut corners. You stop reading the reports. You glance at the headlines. You start making decisions based on news and emotions instead of your deep understandings. You end up with 30 companies you know almost nothing about. This isn't investing, it's just gambling in a nice suit. And I like looking nice in a suit. Legendary investor Philip Fisher warned about this exact problem, saying that investors buy into diversification so much that they put far too little into companies they thoroughly know and far too much in others about which they know nothing at all. This leads to the final trap, the illusion of control. When you own just a few companies, you feel the weight of each decision. You're forced to be careful. You're forced to do your homework. When you own 50, the pressure is gone. It feels more like a game, but the money is very real. You become a victim of Peter Lynch's diversification. He famously said, owning stocks is like having children. Don't get involved with more than you can effectively handle. The old advice fails because it ignores the math, the practical workload, and the dangerous psychology it creates. It sets you up for mediocre results at best. Okay, now before we get to the solution and the exact framework you should be using, if this makes sense to you and you want to go deeper on building a smarter portfolio, consider taking time to subscribe to the channel. We share our insights throughout the week, and this is the situation that you get to see with just about every video. Subscribing to the channel is free. You can join the membership and get more details. And um, it's all about helping you guys become more efficient investors. We on Monday, Tuesday, and Wednesday always talk about how politics impacts your money, how to make more money, and then what country you can make more money in. And then Thursday, Friday, and Saturday, we talk about how you can improve your decision making skills so that you're not wasting too much money on your personal life, which costs you more money towards your future. Because when you're investing in your tomorrow. You're making your later greater. today. Instead of focusing on what's going to happen in your afterlife, focus on what's going to happen after tomorrow night. Try putting your money towards some options that's going to help your kids be better. Start putting, you know what? Even though it's a good idea to focus on building a better future for your kids, build a better future for yourself first, then build a better future for your kids. Because whether or not your kids make it does not change the fact that you cannot guarantee yourself that each one of your kids or any of your kids are going to come back and take care of you when you're too old to work. You want to have enough money set aside for yourself so that you do not have to, at 40, 50, 60, 70, 80 years old, depend on anybody for any reason. So we've laid out the problem. Too few stocks is reckless. Too many is a path to mediocrity and mismanagement. So, how do we solve this? The answer isn't a magic number. Again, it's a powerful strategy used by sophisticated investors all over the world. It's called the core satellite approach. Told you guys about that earlier. This framework is the perfect solution because it solves both problems at once: the need for safety and the desire for growth. It lets you have your cake and eat it too. So here's how it works: you divide your portfolio into two parts: the core and the satellite. The core is the bedrock of your financial life. Its job is simple: provide a broad, stable, and reliable exposure to the market. Its purpose is safety, diversification, and capturing the long term growth of the global economy. You're not trying to be clever here. You're not trying to find the needle in the haystack. You're just buying the whole haystack. It's a lot like poker. Instead of betting on a hand, you buy the pot. So, how do you build it? With a small number of low stocks, uh, broad market index funds or ETFs, for example, most investors, a simple foundation using one or two core funds is more than enough. For example, a broad market US ETF is one investment that gives you a piece of the largest and most influential companies in the United States. So, this is the moment where you guys need to get your pen and paper out because I'm about to start throwing some stocks at you guys for probably the next 40 minutes. Because we've got about 40 of them that we're going to cover, about 40, 45 stocks we're going to cover right now. The Schwab US Large Cap ETF. And you're going to see all of these, or most of these at least, in the tickers down below. But I want you guys to take a look at these. And I'm giving it to you guys on Twitch, Twitter, and YouTube. So everybody's got it, but it will be on the replay for YouTube. So if you come back and watch the show, if you wasn't prepared to write this stuff down today, when you come back and watch this show tomorrow or next week, the information will be on the replay at this exact moment. Now, the other one that you can use is Invesco QQQ Trust, or we grabbed Invesco Advantage, which was QQA. Now, this is Invesco QQQ. And we also, you see our ticker at the bottom, which is Invesco Advantage. Oh, hold on, we gotta spell that, which is QQA. Either one is fine. And let me give it to your boys over here on Twitter X. And you will see, because I made sure that doing research, we double checked to make sure that these tickers are there, they're accessible. Some trading platforms may not have access to them. but it depends on which platform you use. And that's why I give you both of them. Now, a high yield dividend ETF is going to be another one that you're going to use. And some investors, particularly those focused on income, might dedicate part of their core to a fund like Global X Super Dividend US ETF. We're going to give you this one. Yeah, that's a very long name. And that's why I told you guys, you will find all of these in the show at the playback. So that when you go to write these down later, you could write the ticker down, just the ticker, like you seen what I did at the bottom of the screen. And you can write down just the ticker and then go back and look for that ticker uh, on your trading platform, any kind of fintech that you have. I use the Stash app because I feel like that's the best one to get, in my opinion, because it allows for marginal trading. So you don't have fractional investments. You don't have to buy 100% of the share. You can buy a percentage of the share. So instead of buying 30 shares at whatever the value of the share is, you could put up $30 and get as much of the percentage of the share that you purchase, or you could put up $500 even and just get whole shares for every share that you bought a whole share of, and then get a fraction of whatever share that you didn't get a whole share of. So I like utilizing that. And then with Stash, it's $3 a month for unlimited trading. So I don't have to worry about the cost of buying and selling stocks, which encourages me to utilize a dividend rotation strategy because it costs me nothing to buy the stock today, sell the stock in 2 days, and then buy another stock 2 days after that. Now, real estate, hold on, before we go there, that we're looking at the solid base that we've already established with these, and some people might add a bond fund or real estate fund like the iShare Mortgage Real Estate ETF or REM. We throw those in there for more stability and diversification. And this is what you guys are going to be trying to do, just to have like a basic core structured scenario. I'm going to give you some more reckless advice in here coming soon. Just hang in there. And special shout out to my man watching us from Twitter or Twitch, because Twitch is always awesome about diving in. I know that Red Void, Omni 81, Danny Steffen, you guys have been doing a good job of showing us love throughout the last 2 years. Now, with just two or three funds, you can build an ironclad core that's instantly diversified across thousands of companies. Now, this part of your portfolio solves the diversification problem completely. By putting 70 to 80% of your money here, you've already built a safer foundation than a randomly assembled portfolio of 40 individual stocks. Now, me myself, I would put the money into stocks like Arbor Realty, which is ABR, Orchid Island, which is ORC, and I can't remember the name of the other one, but it's PSCC, and we're going to be talking about it soon. It's in this list, and it's one of the tickers down below, because and AGNC, because those are monthly paying stocks. So I would start the first four stocks I would buy are ones that's paying me every month. Diversify that. You do what you want to do, but I feel like if it's paying me every month, and at least two out of the four that I just named are over 18% cash dividend, I feel like that's a better benefit for me in my core, since I'm leaning towards cash growth, not just stock growth. But with this particular setup here, you've guaranteed that you'll capture the market's returns on a vast majority of your money. Now, for the fun part, this is where you get to be a stock picker. This is where you aim for growth that can beat the market, the satellite portion. This is your collection of individual stocks, and you're going to be buying and holding these stocks, not rotating through these stocks like our dividend rotation strategy, which is better for you in comparison to taxation, because any stocks that you're buying and holding in that 121-day period, 60 days before the ex dividend, 60 days after the ex dividend, and the ex dividend date, Those stock options are usually tax exempt up to $64,000 and had a household, and $97,000 if you're married. So if you're claiming your taxes and had a household, all of the money that you're getting there is not going to be taxed for the stock market. So this is going to help your chance to concentrate your best ideas of investing. Now, because you have the safety of the core behind you, you can afford to be much more focused here. So this brings us back to our original question. How many stocks should you have in the satellite portion of your portfolio? Now, according to some of the greatest investment minds, the sweet spot is supposed to be between 10 and 15 stocks, even though I've got about 45 or 50 stocks going across the bottom of the screen there. But all of the stocks that are going across the bottom of the screen there are stocks that we're going to be using throughout the year in our dividend rotation strategy, if not in a buy and hold core satellite portfolio setup. First, we're going to deal with manageability. Owning 10 to 15 companies is a task in intelligence. Dedicated investors can actually handle this. You can do the real research with owning 15 companies. You can read the annual reports, you can listen to the earnings calls. It's not going to take up all of your day. You can actually understand the businesses that you own and shift from being a ticker collector to a true business partner. Second, it forces discipline. This brings us to a powerful mental model from Warren Buffett, the 20 slot punch card. Buffett told students to imagine getting a card with only 20 punches on it for their entire investing life. He said, under those rules, you'd really think carefully about what you want to do. You'd be forced to load up on what you'd already thought about so that you'd do a lot better as a result. This forces you to say no to mediocrity and poor ideas. With only 10 to 15 stocks, you're living this philosophy, and every single stock has to earn its place. So, the rule of the satellite portfolio, of course, is just picking a number that is not enough. We're going to be using the rule to govern this part of your portfolio so that you're keeping yourself safe. So remember, we're not just grabbing 15 for the sake of grabbing 15. We're grabbing the 15 best suited for what we're trying to accomplish. Now, rule number one, the 5% rule. This is your ultimate safety net. Remember, I told you earlier that even if you were trying to do 5% rule, you would have to have enough stocks to do 5% rule, right? Because if you're going to have, because four stocks, 5%, that's 25. If you have four stocks, it's 25%. You know, 5%, you're closer to 20 stocks, right? This is your ultimate safety net. Now, you never let a single stock become more than 5% of your total portfolio value, the core plus satellite at the same time. You don't want any stock to shoot above that. On a $100,000 portfolio, no single stock should be worth more than $5,000. If a stock does incredibly well and growth occurs to about 10%, you are going to trim it back. So if your $5,000 portfolio, if your $100,000 portfolio has a $5,000 stock that for some reason goes up to 5,500 or 10,000, you sell the difference, trimming it back to $5,000, which means that you're going to have discretionary funds available in your portfolio where when you see a $5,000 stock dip, you can start buying into that stock. Rule number two is sector diversification. Even within your 10 to 15 stocks, you need to spread them across different industries. For example, a diversified satellite portfolio might look something like this. Get your pen and pencil ready. In the energy sector, holdings like ExxonMobil, Chevron, Shell, and a nuclear energy uh, play such as Cameo are something that you want to get. So I'm going to give you these. Remember, we talked about, Michael was talking about how Shell had been around for a very long period of time, and Shell was putting out a large quantity of dividends. Chevron actually puts out more dividends than Shell because Chevron is cheaper by share. However, depending on depending on what you're trying to accomplish, you could, in fact, get them both and compete them against one another. You could, in fact, get Shell and Chevron and Exxon, but these will help you with the oil boom. Okay. When wars are happening and conflicts of interest are occurring, oil goes up in price. So if you're investing in these, you will see the oil go up in price and you will see the stocks go up in price. So you'll be able to get your money's worth off of recognizing that for the summer, I kind of want to hold a lot more of these. Now, high yield and BDCs is a basket of income focused companies like Two Harbor Investment Corp or Orchid Island Capital, AGNC Investment Corporation, Oxford Square Capital, or Prospect Capital Corp, which was a PSEC that I told you about. Let me give you this list because this is a lot of them. I want you guys to be able to have all 40 of these stocks so that you know where we're going when we start picking up on some of these stocks. Now I know that Steven, special shout out to Steven, special shout out to YOLO Cashflow and the Trading Network on Twitter. But I know Steven is going to be like, "Oh man, I missed it," because he's been working late lately, and I know that he's going to be wanting to see all of these stocks. So make sure that you take the time to like and subscribe because you can always come back and get these stocks on the replay. Now let me give you the other half of these because these are all of cash stocks, and this is like what I would have used as my core is like Two Harbors, Orchid Island, AGNC. I would have used uh, Prospect Capital Corp. I would have been using stuff like that in my core instead of using broad spectrum uh, uh, ETFs. And the reason why is because I'm taking higher risks off of the greed of achieving higher returns from higher percentage rates. Now, real estate is going to be a mix, including mortgage real estate investment trust like Arbor Realty Trust and hotel operators like Host Hotel and Resorts. So let me give you both of these. Y'all gonna be like, golly, this man is throwing. Yes, sir. We throwing a lot of stocks. I'm throwing stocks into the I'm throwing stocks into the into the comments section, like throwing money at a stripper. We like tipping out an OnlyFans girl. I'm giving you a whole setup of wealth that you guys can manifest. And now you don't have to sit here and say, "Oh, I'm gonna go and talk to my trusted advisor," because what you're gonna say now is, "Oh, I'm gonna go talk to Xander, my trusted advisor." Now, healthcare and consumers is going to be another market that you're going to want to get in, a different industry. and established giants that we've talked about plenty of times before, like Johnson and Johnson, Medtronic, PepsiCo, are ones that you want to get your hands on. So I'm going to give you these as well. You're going to be looking at a lot of these coming into the comment section. Uh, I'm getting them in clusters, y'all. So you're going to see like three stocks. It's going to have the stock and the ticker, and then another stock and another ticker. So this is going to be a laundry list of stocks that y'all are gonna see here. Now, in technology, we just covered this the other day, so this is going to be beneficial for you in more than one way because since the fifth is just a week and some change around the corner, we're looking at having to get ready to switch over our TikTok platform to another platform because of the merger, the US buying out TikTok. And Oracle is a part of that. So when you start talking about technology, leaders in the respective fields like Oracle and Broadcom are ones that you guys want to look at. Oracle should have a massive boom if they can manage TikTok. So you think that the first 30 days or 90 days when they get the stock that they're going to blow up. That's not necessarily the case. They might blow up immediately after that, though, 6 months down the line when they're holding on to a steady success rate of the 170 million American users because Oracle would be effectively buying 170 million users when TikTok is sold. Now, infrastructure and financials is going to be a different market, and companies like Sterling Infrastructure and a regional bank like First Community Bank Shares is other ones that you can grab. And all of these that I've talked about so far, for the most part, have been scrolling across the bottom of the screen. So we're following all of these stocks. I'm staking my money on it. Now we talked about these coming up, the travel and leisure department. The Somebody asked me before, is it better to buy in the airlines or cruise ships? Well, I'm going to tell you right now, when you start talking about a dedicated travel ETF, you want to think about some like US Global Jets, which is airlines. And I believe that US Global Jets is a growth stock. And then you have cruise line operators like Carnival Corporation, which is going to give you the cruise ships. Now, depending on which country that you're in, you can invest in different stocks in different countries. But here in the US, we kind of want to get ourselves involved in some other stock options and make ourselves fundamentally successful. Now, granted, just because you're putting all your money on all of these stocks doesn't mean that you're going to be rich overnight. What it means is that you will have the capabilities to um, invest in in some of these things and then turn back around and get some of the dividends off of them. And that's why my approach for these was supposed to be something tad bit different. Instead of getting a massive quantity of growth out there, the goal was to you well instead of getting a bunch of stocks, the goal was to get a lot more growth off of getting the highest paying, lowest costing cash dividend stocks first, and then expanding my portfolio. So by the time I get to 20 stocks, I should be seeing a dip in my average dividend that I'm probably not going to be happy with. But I'm also going to be seeing a consistency between having the capability to sell when some stocks are high and having the capability to buy when other stocks are low, which will allow me to rebalance my portfolio more often than not, which gives me more of a capability of experiencing the average overall portfolio of 20 to 25%. And then I also still have the capability of using the rest of the money and rebalancing on the dividend rotation strategy. So whatever into my primary buy and holds portfolio, The rest of it I use in my dividend rotation strategy, and I'm going to hit it on a quarterly regardless. So it'll work itself out. Now, rule number 3, you want to know what you own. This is the Peter Lynch rule. Only invest in a company if you can easily explain what it does and why it will be more valuable in 5 years. This is especially critical for companies with complex stories or high volatility. Before you invest in companies like Tesla, Uber, NIO, Paramount Global, or highly speculative assets tied to digital currencies like Riot, Coinbase, or MicroStrategy, you must be able to explain your investment thesis clearly. So I'm going to give you most of these. Well, I'm going to give you all of these, but most of these don't necessarily need a ticker because they are their own ticker. Uber is its ticker. Tesla is TSLA. That's probably the only difference between that one. NIO is NIO, so I'm going to be giving you these and you'll be able to find these when you go looking. And this helps you navigate the ins and outs of how this is going to work for you. And then we're going to grab Riot, Coinbase, and Coinbase is going to be COIN. So we're going to put that in there. And then we're going to be putting Masters in there because that's going to be the ticker for the other one. MicroStrategy is, you're going to see that one across the bottom of the screen, which is, it's coming up as a matter of fact. MSTR is MicroStrategy. The same is going to apply to thematic ETFs. So let me put MicroStrategy up here for Twitter X. And then we will get these. Now, if you want to own Global X Cloud Computing ETF or a company like Big Bear AI, you need a deep conviction about the future of that specific niche. So if you can't explain it simply, you have no business owning it. So do a little bit of research before you go running out and grabbing some of these. You can follow us while we do the research for you, and then you can grab all of them. Or you can do a bunch of research yourself and then go grab the ones that you feel comfortable with. After the research I've done, I've led to the observation that these are good to get. And these are the ones that I'm going to have. Eric, one of the fans on the show, was actually talking to me about BDAI because he brought it to us like last month, I think. And when he brought it to us, I was like, oh, Dip, I did not even know about BBAI. And the first thing I did before I added it to the collection was I went and did some background research on BBAI and then found out at the time that BBAI was operating at $7.75 a share, but it was a growth stock, not a cash dividend stock. Now, rule number 4 is going to be having patience. Patience is the key. Now, the satellite portfolio isn't a day trading platform portfolio. You have to understand that. The goal is to buy wonderful businesses at fair prices and hold them for years. So when you're getting these, you should have been getting like 20 to 40 stocks. And when you're getting these stocks, you're keeping them. So what you're going to do with them is basically rebalance the ones that go up and take that profit and buy into the ones that go down so that they stay in a good position where everything goes up or Everything that is down will get more investment in it so that when everything else goes back up, it will stay high. Because what goes down in the stock market typically goes back up. And what goes up in the stock market typically goes back down. So when one goes up, you sell it and then buy into something that went down at the exact same time. And when something goes down, you buy into it so that it will match up with something that went up, keeping your portfolio at an overall increase. Because remember, if more than 80% of your portfolio is growth stock or cash stocks, the more uh, stocks that you buy, the more shares that you buy of your cash stocks, the bigger your dividends are going to be, which also means that your consistent payout every month is going to be the same. And that's when you start getting a standard of living where like Tom Jacobs and Brett Owens was talking about living life off of 8%. And I'm like, we could probably live life off of 8% after taxes and inflation, but we're probably going to be rolling in it at between 15 and 25%, 27%. So, as Warren Buffett says, his favorite holding period is forever. So, you're a business owner, not a stock renter. By combing a rock solid core with a focused satellite portfolio governed by these simple rules, you truly get the best of both worlds. The 70 to 80% of the core provides the safety and the market returns that builds your wealth and your foundation. The 20 to 30% in the satellites gives you the potential for serious outperformance. And this is going to be driven by your own best ideas, all protected by strict risk management moves and rules. So we've covered 40 stocks already. What is the recommended number for stocks to hold in 2025? For 70 to 80% of your portfolio, the answer is thousands. Held easily at a cheaply thorough, just a few broad market index funds scenario away, right? Or you can do like I did and just grab the most volatile ones that are at their lowest right now because they've already dropped 85% since Trump got into office and now they're on their way back up. You can just grab those. But this will be your core and your source of safety. For the other 20 to 30%, the answer is between 10 to 15%, or 10 to 15 shares or stocks. Now, this is your engine for growth. That 10 to 15 stocks is going to be your growth engine, a focused collection of your best, most well researched ideas. And it's a number big enough to give you some diversification, but small enough that you can actually manage it like a pro. The debate between diversification and concentration has been a false choice all along. You don't have to pick one. The core satellite strategy lets you have both. It protects you from catastrophic risk while saving you from diversifications that dooms most investors to a lifetime of average returns. So stop collecting tickers and stop chasing hot tips. Stop thinking that owning more stocks makes you a safer investor. The path to building real wealth isn't about specific numbers, but about better framework. Build your fortress with a diversified core and then send out your elite soldiers, your 10 to 15 satellite stocks to win the battle for growth. That's how you build a portfolio that truly works. If this framework resonates with you, hitting that subscription button, making sure that you guys like and subscribe, and always mashing those reaction buttons and utilizing the notification bell, you will have the capabilities of not only showing a lot of support for the channel, but also not missing out on some of the other videos that we have coming up throughout the week. where we will be breaking down exactly how to find what you might consider your first satellite stock. Now, for those of you that jumped in towards the middle, I want you guys to know that we have 40 stocks spread out over the course of the last 30 something minutes. So you might want to go back and take a look at those, or jot them down, and start applying them. You also see those stocks scrolling across the bottom of the screen. So you also want to write them down as you uh, maintain your observations on the show. But remember that being able to improve your wealth and being able to improve your status requires you to put forth proactive effort into finding ways to make money for you so that you are not dependent upon how much money you're capable of getting from somebody else. Instead of putting your effort into making somebody else rich, start putting more effort into making yourself rich. Think about that for a moment. Now, I want to say thank you for coming to the show, ladies. As long as the situation doesn't make sense, I'm going to keep asking you to make it make sense. So, ladies, please make it make sense. Fellas, we're about 73% male podcast from the male perspective, and this information is given to you guys to help you guys become higher valued individuals, higher value men. We're going to be giving you information to help you with your financial life to improve your status as a financial individual, successful. But we're also putting this information out there Thursday through Saturday, especially to help you improve your decision making process in your personal life because they both play off of one another. When you're having trouble in your personal life, you can't focus on making money. When you're having troubles with money, you can't focus on your personal life. We want to give you that work life balance, or we want to give you more time for your personal life so that you don't have to work at all, whichever one comes first, right? But in order to do that, we have to work on the money, Monday, Tuesday, and Wednesday, and then work on a personal life Thursday, Friday, Saturday. Now, remember, Sunday is questions and comments from the fans. We take interactive communication from all the platforms, YouTube, Twitch, and Twitter. And we might even, after September 5th, incorporate TikTok into this eventually, depending on how their algorithm works. So take that into consideration that going forward, we might actually merge TikTok into the platform alongside Twitch and Twitter and YouTube, which is an upgrade to the platform. So that means that we're becoming more successful. So we're going to be working that into the fold. It is a highly interactive podcast when you guys decide to interact, and you guys can communicate to one another across platforms because you will see your comments in the comment area right here as well as over there. So that'll help you guys with cross channel, cross platform communications. But remember, we do not let the sun rise without going live, and we are live 7 nights a week. So just keep an eye out for the next thing that we got coming up. Now, since tomorrow is Wednesday, we're supposed to be talking about a different country that we can invest in and live in for more affordably. And we have other information out there about how to get offshore accounts and establish other areas of financial security like trusts and C corporations and LLCs and other such things. And I encourage you guys to take a look at those because it gives you a thorough walkthrough on how you can protect your assets by relocating the ownership of the assets, and you control the owner of the assets, and that makes it better for you. With that being said, I want to thank you guys for coming to this and that because we had a very decent, actually shorter than I thought, conversation about the best portfolio that you could put together for yourself here in 2025. And for those individuals that are starting up, this is the kind of portfolio that you can do. Start from the cheapest ones, work your way up to the most expensive ones. Start from the ones that have the highest payouts, the highest dividends per year, and work your way up to the ones with the lowest dividends per year. If the first 15 that you get are the highest paying stocks that are the cheapest dividend stocks, and you stop there, stop at 15 or 20, and you're averaging 17% return, average your 17% return. If you decide to dive a little bit deeper, bring your returns down closer to 10 to 20% dividend return, and deal with more growth and less ex dividends, do that as well. Whatever you decide to do, whatever direction that you're trying to go, whatever your idea is, the goal is to put more effort towards making money, make money for you so that you're making money in your sleep. I think it feels better for me to wake up every day and then check my stocks and rebalance them and then go find something to do. Or before bed, check my stocks, and then go to sleep. And I've either rebalanced them first thing in the morning or I've rebalanced them once that night, but I'm only really on that once a day. I'm not a day trader. I'm not up there all day, every day, watching the stocks tick and then, oh, sell, oh, buy. I'm not that guy. You know, at the end of the day, once the market is closed and everything is settled, this is where it is, and this is where I'm going to move my money. And some experts might say, hey, you got to be there first thing in the morning. But for the beginners, first you got to practice knowing which ones to buy that you benefit from, and then you want to work towards uh, learning how to trim them, learning how to hedge them, learning how to sell just enough to cover the difference, and then buy just enough to cover the spread. And then you can start focusing on day trading if you want to day trade. But if you're going to day trade with a percentage of your portfolio and the rest of your portfolio is still consistent, where you have your 15, 20, 30 stocks that are consistent, whatever you do with the rest of the money is up to you, because your security is the core satellite. Your high risk is dividend rotation, Bitcoin or whatever, cryptocurrency. You can take some of this and start putting it into gold and silver or buying gold and silver ETFs. Whatever you decide to do, just find your 20-year plan with the idea that you're sticking with that 20-year plan for up to 20 years. The same way Trump is doing that Trump fund. We're going to be talking about that on Monday, talking about how we're going to be putting money in newborns' pockets, where by the time those newborns become 18 to 20 years old, they'll be able to get that investment 20 years down the line. But that still requires somebody to invest in it for 20 years. Setting up a 20-year plan at birth, give the kids something to hit the ground running with. Teaching them financial responsibility from 4 years old. When they're old enough to ask for a piece of candy, they need to know how to diversify. Making the next generation more knowledgeable. So take that into consideration when you start thinking about what have you done this week to better yourself. What have you done? Have you quit an old habit? Have you gotten rid of some wasteful spending? Have you reduced some of your costly entertainment? What have you done? Have you learned some new skills? Have you removed toxic people out of your life? Have you removed unfavorable individuals that are not benefiting your agenda, individuals that are utilizing more of your resources than they're providing to you? What have you done to improve yourself in the last week? And if you can't think of anything, you should probably start thinking now. You should probably start trying to find a way to take time out of your week, time out of your month, to start planning for your future. Get that 5, 10, 20 year. Start with a 6-month goal that leads to a 1-year goal, that leads to a 5-year goal, that leads to a 10-year goal, and work that. Every week, see how close you get to your 1-month goal. Every month, see how close you get to your 6-month goal. And every 6 months, see how close you got to your 1-year goal. That's what you need to be focusing on. No matter how you do it, whether you're trading with us or you're doing something else, find a way. If your goal is to work for yourself, figure out how close you can get there in the next year. If you want to be a content creator, figure out what all you got to do to get there. If you want to be wherever it is that you're not, start making a plan on how to get there. So with that being said, I want to thank you guys for coming to tonight's show. Thank you for coming to this and that. I'm your host, Xander, where we talk about this, that, and everything in between. And I will be seeing you guys tomorrow night.
Higher ground. My network is my net worth. Choose your company wise. Surround yourself with eagles, not with sheep in disguise. Every interaction is a reflection of my brand. Quality over quantity, that's my personal command. I'm not